This turbulent week is coming to an end. The long-awaited data on employment in the United States private sector and the jobless rate have been released and brought not the best news to risky assets. The situation is not dismal at all. Stock investors have found a faint hope. As expected, the benchmark stock indexes closed yesterday with minor changes. The Dow Jones shed 9 points, or 0.03%. The Nasdaq inched down by 0.12%, and the S&P 500 slipped by 0.13% to close at 4,258 points. The highly anticipated report by the Labor Department dampened fragile optimism on Wall Street. Futures on the stock indexes traded in the red, losing 0.4 and 0.6%. The S&P 500 is expected to trade in the intraday corridor between 4,180 and 4,260 points. The stock indexes closed yesterday with the dips, having rebounded off intraday lows on Thursday because investors were alert to a monthly official employment report which could shed light on the Fed's agenda. US initial claims for unemployment benefits pointed to a still firm labor market. On the previous day, the ADP employment report showed that hiring in the US private sector increased less than expected in September. The bond explosion that shock markets has now been partly dampened by a sharp drop in oil prices. US Treasury yields fell. Earlier this week, it reached its highest level since 2007. San Francisco Fed President Mary Daly said on Thursday that with the US monetary policy deepening into restrictive territory and the recent rise in US Treasury yields, the Fed may no longer need to raise rates. Fed futures markets have reduced the likelihood of another hike in the cycle to less than 50%. Stocks finished well below the weakest levels of the session, while the S&P 500 held above its 200-day moving average, which currently sits at 4,206 points. In the corporate world, Dell shares dropped by 1.5% after the company's earnings forecasts showed artificial intelligence incentives may take longer to materialize. On a Friday, US stock index futures fell sharply after a closely watched jobs report signaled a still tight labor market. Although the indexes slowed the pace of a decline slightly by the opening bell. Employment rose sharply in September, suggesting the labor market remains fairly strong, although wage growth is slowing. NONFARM payrolls increased by 336,000. Economists had a forecasted job growth of 170,000, and data for August was revised upward to show the addition of 227,000 jobs. The strength of the labor market 18 months after the Federal Reserve began raising interest rates to cool demand suggests monetary policy could remain hawkish for some time. At the same time, the unemployment rate in the US amounted to 3.8%, remaining unchanged and exceeding market expectations of 3.7%. The number of jobless remained broadly unchanged and stood at 6.36 million people. The so-called U6 unemployment rate, which also includes people who want to work but have given up looking, and those working part-time, dipped by 7% from a 7.1 in August. Another indicator reflected that the United Auto Workers strike had no impact on wages. The end of a months-long strike by Hollywood actors also did not provide any incentive. Monthly wage growth remained moderate, with the average hourly wages rising by 0.2% after a similar increase in August. In the 12 months to September, wages inched up to 4.2% after rising by 4.3%. Wages are still growing faster than a 3.5% growth rate that economists say is in line with the Fed's 2% inflation target. As favor, people quit the jobs in a search of more pay. Wage growth could slow down, although recent large union contracts pose a risk. The strength of the labor market supports the economy with a third quarter growth forecast at an annual rate of 4.9%, more than double the non-inflationary rate of about 1.8%, according to Fed officials. Dark clouds are gathering. Another worry in the bond market: stagnant US fiscal policy and the prospect of another government shutdown next month remained unresolved as Republicans moved to appoint a new House Speaker. Former President and the leading candidate for the White House next year, Donald Trump, said he's backing Congressman Jim Jordan for the job, an appointment that would discourage any bets on a congressional compromise to avert a shutdown. That mixed picture of a fiscal dysfunction and potential economic disruption due to the layoffs of thousands of government workers in the backdrop for Treasury Secretary Janet Yellen's trip to the annual meetings of the International Monetary Fund and the World Bank in Morocco next week. In the corporate world, Tesla shares fell by 1.47% to 256.22 in the pre-market trading after the electric vehicle giant ramped up aggressive discounting and cut prices for its Model 3 and Model Y vehicles in the United States by about 2.7% to 4.2%. ExxonMobil is in the talks to acquire Pioneer Natural Resources in a deal that could value the Permian Shale basin producer at about $60 billion. However, corporate news is unlikely to have a major impact today on the market, which is trying to wind political risks, employment growth, moderate wage inflation, and disinflation in oil prices. In the currency market, the US dollar is unwilling to give up its leadership. Its index traded at 106.70 before the opening bell, 0.4% up. The intraday Canada for the index is seen between 106.40 and 107.10. The dollar advanced on Friday following the release of the September NONFARM payrolls, which hinted to the market that the Federal Reserve is likely to raise interest rates again this year. The dollar index rose by 0.6% to 106.96 immediately after the report, but the index later paired momentum as the market still had reassuring data on a weak wage growth. In any case, stock investors can look for the consolidation in the later indicator. All in all, the conclusion is as follows. The US economy is healthy. The prospects for the dollar are clearly bullish. Its further growth isn't out of the question, at least until new statistical or political shocks. The Canadian dollar has perked up against its American rival. The USD CAD pair settled at about 1.3723 before the opening bell and 0.14% higher. The instrument is likely to trade within the intraday corridor between 1.3700 and 1.3750. Fresh statistics today showed that Canada's unemployment rate remained unchanged at 5.5% in August, just shy of the 5.6% estimate, while data pointed to a cooling in the country's labor market compared to the previous year. The unemployment rate remained well below the pre-pandemic averages. In terms of employment, the Canadian economy added 63,800 jobs, well above estimates of 20,000 additional jobs. This week, the loonie suffered from a decline in oil prices by almost 15%, but domestic statistics and the weakening dollar helped the loonie to slightly minimize losses. In the crypto market, assets are still trading sideways. Remarkably, key assets display resistance to shocks. A decline in Bitcoin would have looked logical based on the data from the United States, but traders decided otherwise. Phase in the flagship crypto kept the price close to $27,500. Ethereum also maintained its growth and added 0.7% before the closing bell yesterday. There was no significant news from the cryptocurrency market today, but the underlying assets showed relative stability. It's possible that investors really believe in a historically successful October and are ready to wait for good news. As for Bitcoin's intraday outlook, the asset returned to the range of $27,400 and $27,750. Here, it can continue its flat movement. Going beyond the borders will lead to the token to either $26,900 or $28,200. Make profits with the InstaForex. Have a nice weekend and see you online on Monday.